So,
We call the meeting to order. This is a general fund meeting by the Council of Revenues, Monday, May 15, 2023. First item on the agenda is, has there been any communications to the council, Dr. Kobe?
No, there has not.
Okay. I guess it's communication to the council, public comment. Does anyone want to make any public comment or communicate to the council? Okay. No one raised their hand. I can't see anyone raise their hand. Okay. Okay, we have not had any communication or public comment. Okay, next item on the agenda is the minutes of the March 7th, 2023 general fund meeting.
Move to approve.
second,
Okay. Any discussion about the minutes of the March 7th, 2023 minutes? Okay, if there's no one that wants to discuss it or any comments, let's take a vote. Vice Chair Newell,
yes,
Dr. Siderhout,
Yes.
Dr. Bonham,
Yes.
Council Member Maynard,
Yes.
Council Member Hayashi.
Yes.
Okay, so the minutes are approved unanimously. Next item is the discussion and vote on general fund tax revenue forecast for fiscal year 2023. Dr. Kobe, did you want to say anything?
Sure.
Excuse me, I think there was we skipped over the review of revenues by,
Oh, sorry, yeah, I'm sorry. Yeah, I skipped over it. I apologize. So the
No problem.
next item is review of revenues by Department of Tax.
Okay, I'm just gonna go over a couple of things really quickly. Let me know if you can't see the screen. So just wanted to go over where we were in terms of revenue, right? Just as a reminder that a lot of our general fund forecasts have been accounting impacted by the constitutional refund. The constitutional refund has come out to be around $311 million, which is equivalent of 3.3% of the fiscal year 2022 revenues. Right. So here's where we are as of April. Now,
Can I ask, I'm sorry,
Sure.
can I, so why, just to be clear, why are we calling this the constitutional refund? Because it was under.
Yeah, it was done through the constitutional mandate that says that if there is over a certain amount of revenue relative to expenditures, there should be that, and that was the mechanism to do that.
Is it 5% for the last prior to consecutive years? 5% of
that is the threshold. However, the legislature has a lot of mechanisms and authority to overrule that and just to stash that wherever it likes. So unlike like Oregon, which has a very, very strict constitutional refund mandate, Hawaii is rather loose. So what happened with the constitutional refund last year was it was proposed by the Governor Ige, and it was approved by the legislature with these types of provisions, right? Which is either $100 or $300 per exemption, depending on your level of federal adjusted gross income. And as a reminder, most of that came out in of the general fund revenues in September and October of last year. So this is where we are for as of April, right? So one of the big questions is what's going to happen in April, because last year we had this massive increase in general fund revenue. I'll go over a month by month comparison in the next slide, but this is overall where we are year to date. So we're down 1%. And all of that, nearly all of that is driven by the individual income tax, right? So we're still doing pretty well in terms of GET, where TAT remains strong, which are the two other biggest income drivers, but it's individual income tax. We're down 18.5%. Now, if we adjusted for the constitutional refund, things would be down 8.6%. Most of that is coming from declared estimated taxes and payments with returns, right? So you could make an assumption that's all from the stock market. You could make an assumptions from the real estate market. There's a lot of things that are driving that. Carl and I were talking once, and I think just given the size of the real estate market within the state of Hawaii, I would think that that's a really big component to things, because you can imagine that realtors and everybody involved in there are based on commissions, which means that they do most of their payments through estimated taxes. Just to
So it's
points-
also business profits.
Yeah,
Business
no,
profits normally get paid as estimated tax payments. and payments
exactly, right? So
returns.
the issue is like, at least at the public level, through that would be paying corporate returns, they're actually having record profits, right? So they continue to see really large returns. So one of the big things is this driven by lower business revenue, or is it driven by poor stock performance? Is it driven by real estate? We don't really have a good handle on that, but those are all different types of hypotheses.
The corporate revenue is very small, right? Isn't it like 1 to 2% on
Yeah.
average?
Yeah,
So
but
the non-corporate profits might be down as part of this.
it's true, but then you would have to come up with a reasonable explanation of why corporations who pay corporate tax are doing well, but S corps and partnerships are not doing well, which is a total possibility, right? So just as a reference point, this is happening at the entire level for all states, right? In fact, New York and California are seeing their individual income taxes even much lower than we are, right? So the states that have very progressive tax structures that rely heavily on the earnings of the wealthiest people have had the biggest decrease in taxes. This is happening at the national level, so the IRS is seeing this. This is happening all around the place. And the other thing that what we were kind of in line with expectations, right, is the GET and the TAT are mitigating the fall in income, right? Which is kind of what we expected with the, tourism is doing okay and helping to mitigate all those things. This is just a comparison of April 2022 compared to April 2023, only that month. So given that April is such an important month, I wanted to pull this out and look at what's going on, right? I'm just going to focus on individual income tax right now, but if you guys have any other questions, we can do that as well. So what you really see is it's declared estimated taxes is down by 25% and payments with returns is down 33% relative to the last year. And our overall individual income tax collections for the month of April are down about 20%, right? But it's really important to notice that withholding on wages remains pretty strong, even in April and everywhere else, which has something to say about the jobs market and where we are with things, right? So you can make your own inferences about what that means in terms of the overall macroeconomic outlook and what's happening here. But it does mean that, we were about 11% down in terms of April collections as opposed to last year. That is about average. I did an informal survey and I talked with a lot of people from the other states. That's about average of where tax collections had fallen for other states as well that rely on the individual income tax. Does anybody have any other questions about that? I'm going to move on.
Any questions, Seth?
Okay.
Yeah, Seth,
Yeah,
I do have one
Marilyn.
question.
Mhm.
When you're looking at this, what has happened, what I see in my practice is people are during the pandemic, a lot of people decide, hey, I'm going to throw the towel in. I won't, I'll retire. And that basically meant that instead of getting regular wages, W-2 wages, they're getting pension income. Have you looked at the pension income to see how much was excluded? Is that number increasing quite a bit?
We're not going to have that information for 2 or 3 years, right? Because we have to look at their tax returns to do that. And this is how things come on through our kind of our accounting system.
Okay, so there's no separate line saying this is a pension.
No, we need to, in order to do that, we need to look at we actually need to look at people's individual income tax returns.
Okay.
Okay. So just to give you an idea of where we are, right? So this is general fund collections. The dark solid line in red is fiscal year 2023, which is where we are. The dotted line is the adjusted, right? So if we added the constitutional refund back in, and the orange is fiscal year 2022. What you'll see is real collections didn't do as well at the very beginning of the year. If you adjusted them up, they were doing well. And now we're kind of getting to like flat to something around flattish, right? And then in April, we're doing worse than where we were the previous year. Just as a reminder, most states, including Hawaii, still get some of their individual income tax collections from April and May. We're doing that less and less as we've computer automated everything, and we're doing our collections faster than normal, but that is still an impact. And then the other thing to think about is June tends to be a strong collections month because of estimated taxes as well, right? So the two things that are going to really drive the rest of the year, general fund is probably expected not to do as well as they were last year. So that's just something to keep in mind.
What are the two things?
The fact that normally we have additional revenue in May because we're still collecting all the stuff from the April 15th tax things, but since we're processing everything faster, most of that's in April, right? So we're not expecting a big surprise or additional revenue in May. For comparison purposes, we're collecting everything just about the same amount as we were last year, right? But in June, we're expecting another payment of estimated taxes. And those estimated taxes have been down on the year, right? So I wouldn't expect June revenues to offset where we were going forward. In fact, I would imagine the same types of trends. The monthly GET revenues continue to be relatively strong, right? And I would, my hypothesis is this will continue to collapse, right? As the effects of closing down and COVID goes further and further away, we're going to get more to instead of being 20%, 15% over the previous year, we're going to get closer probably to 7 or 6%, depending on inflation and things like that. Just as a reminder, this is your forecast, right? So your forecast is for 2% in fiscal year 2023, 4% in 2024, and all the way down. Just for people on the call, it may not apply to the Council on Revenues, but in my discussion with a lot of people, there's been this feeling, we have lower rates of growth, so there's actually fiscal lower rates of revenue growth, so that means that we have less money. But I just want to there's a big difference between levels and rates, right? And so one of the things that we're trying to deal with, and you guys are responsible for guessing, is what happens after you have a 30% increase in tax revenue, right? You expect some kind of either leveling off or mean reversion, but the state still has quite a lot more money than they were anticipating in 2017 or 2019 before the pandemic at this point, right? And so even though if you do have zero or slightly negative growth, given that we were growing at 30% the year before, means that the state still has a lot more money than it was intending on collecting as of a couple of years ago. So I just wanted to say that because I know that there seemed to be a lot of confusion out there about rates and actually how much money the state is collecting on that. So I'll stop. This is yeah, one more. This is where your models say the rates and things, your general fund output or the general fund forecast based on models with and without the constitutional refund, right? So you can keep that in mind. I'll save this slide for another bullet point discussion later on in our meeting.
Thank you, Dr. Kobe. Any questions of Dr. Kobe? Okay. So moving on to the next item is a discussion of the current year's revenue, fiscal June 30th of 2023. Jack, you want to lead us off? Sorry, Carl.
Not particularly, but I will.
Oh, okay. Since I called it.
Well, Seth's comments on this last slide, I think are really quite important to us, because basically what we've seen in the numbers is a shift up in general fund revenues from basically about $7 to $7.2 billion pre-COVID to now we're talking about close to $10 billion. And as you saw in that slide of his, what we are forecasting is that huge increase, which comes close to 50% if you compare to 10 to 7.2, is whether that is a permanent shift or just kind of a one-time bubble sort of thing. And if it's a one-time bubble, then I don't think that our present forecasting assumptions capture that bubble aspect of it. Sorry about the dog in the background. And I think that I just don't know. I don't know what would have accounted for that shift in revenues, given that I know things have changed in the tax structure somewhat, but not to this extent. So that's my concern about our forecast going out. And that's all I have to say at this point.
How much do we think is due to inflation over the last couple of years?
Well, let's say 5 or 6% or so.
Is that a cumulative or per year?
Well, 5 or 6% a year, so
10 to 12%
Yeah.
might be.
yeah.
So when I look at the components of income tax collections, the thing that strikes me is how big the refunds are in this fiscal year. They're lower than they have been. I'm sorry, they're larger than they have been going back a decade, except for last year's constitutional refund. And that's not something that to get to Jack's point about whether or not this is a permanent increase in tax revenues or temporary, that's not something that you would expect would continue. And I think there's still some room for estimated taxes to come down a little bit more. I'll see if I can share my slide or my screen.
Dr. Kobe, can Dr. Bonham share his slide?
Let's see.
Let me know if you have any problems, Carl. I think you should be able to do that.
So if you can see that,
Mhm.
the black line there is estimated income. These are year-over-year growth rates, and the black line is estimated tax payments. It's revenue from estimated tax payments. And the blue line is total statewide sales volume. It's actually a proxy for sales volume. It's total sales multiplied by median prices statewide. And it's striking how similar they are. And the reason I was looking at that was getting at what Seth was talking about, was that a big piece of the estimated tax decline is almost certainly coming from the collapse of home sales, right? Because every one of those realtors is working on a commission, and most of them are paying Schedule C, and that would also be true for payments with returns, right? And with the size of the drop in sales that we've seen, 40% drops in sales, and some drop in prices, their income has fallen sharply. And that's just real. Then on top of realtors, there's appraisers, there's title companies, the whole process. So I guess my take on the components is that estimated taxes are likely to fall. As Seth pointed out, we normally would expect a good June. We're not going to get a June this year that's better than last year's. We'd be really lucky to even get close to last year's June. And yet, as we go into next fiscal year, I think that's going to, that sharp decline is going to end. So my sense is that we're actually very, very close to getting back to normal. After this enormous run up in the previous fiscal years, it feels like we're getting back to normal, and the main components, wage withholding taxes on wages, to Jack's point, are still well above where they were pre-pandemic, right? So, even nominal visitor spending is well above where it was pre-pandemic. In real terms, visitor spending is about where it was pre-pandemic, and in nominal terms, it's dramatically above that. So there is reason to think that level of tax revenue will stay high. And the thing that I don't quite understand is the refunds and why they're so large this year. I'm not sure of any changes that would have led to that. And I guess I would expect that would normalize as well, right? You would expect in the next fiscal year, not necessarily this fiscal year, but next fiscal year.
Well, with the refunds, if you extrapolate your idea for the real estate sector, right? So the real estate, the heat in the real estate markets, stopped around last June, right? And then they would continue paying high. And then so all I'm saying is that really supports your real estate hypothesis.
Clearly some of those refunds could be people who had paid in too much because they were anticipating much better revenue than they saw.
Councilmember Nguyen.
Yeah, what I wanted to mention this last year is there were a lot of people who had withholdings on HARPTA, non-residents who were selling their real estate, and a lot of them wanted to get their money back. And so most of them, I would think, would have applied for a refund once they filed the return in this year, for last year, and they would get a refund. I'm not sure where the HARPTA withholdings would have gone, whether it would have gone under withholding on wages or estimated taxes. I think I asked this question before. Does it go into estimated taxes? The HARPTA withholdings. So that's
okay. So it is. I don't have the answer to that. I don't know. What's the question? With certainty.
Well,
it's not withholding on wages.
It's not withholding on wages.
So then whatever money came in, there was a lot of it, a lot of sales, a lot of withholding, HARPTA withholdings, because people have been selling their condos and real estate here because of the appreciation. But I think
that would result in more tax revenue, right?
No,
If things have been
refunds.
going on, why would it be?
Refunds, because they all had rental condos, for example. And if you add in their passive activity loss carry forwards, if they had any, it'll result in them getting refunds, not payments. And so,
Okay.
And so this is consistent with a 40 to 45% drop in sales. All these people selling their properties. I don't get it. When did they sell
Yes.
them? Last year?
last year, the year before,
Mhm.
I've seen so many people come to me and say they want an exception for this rule and all that. So there's a lot of withholdings on HARPTA that automatically kick in on the gross sales price for the real estate. And
I would say this, Marilyn, the HARPTA issue shouldn't affect April, right? The HARPTA allows you to get your refund and do things before without having to wait all the way to April 15th to file your
no,
taxes.
most of these people have such trouble filling out the forms to get your refund back early. If you look at the forms that you need to turn in, quite a lot of extensive information required. So a lot of them say, okay, well, we'll just wait and file for the refund with a tax return. So instead of filing for an early refund, what they're doing is just filing a return, and they have to file a return anyway. So what I tell them is, you're going to have to pay for the preparation of the tax return anyway. And so if you do all this other work, you have to pay for those fees, and then also pay for the preparation of the tax return. So a lot of people tend to wait and just file with a return.
Marilyn, do you have a lot of Japanese clients? Because I heard that was happening with regard to Japanese investments because of the yen being so strong. They're willing to take a loss, as far as from a dollar perspective, because the yen being strong was offsetting some of that. Just curious, did you notice that in your client base?
Maui mainly has people from the mainland or
Like
foreign,
Canada,
like
right?
Canada. Canada.
Yeah.
And everybody's looking at the prices here because the appreciation on property has gone up so much. And I guess some local people says we'll just sell out because we got, we can sell for so much more. And so that's what they did. But of course, if they sell, they'll never come back to Hawaii because to try to buy back in, it'll be too expensive. So they made the decision that financially they're better off selling because of the price increases. And you know how real estate is always cyclical. They felt that this was kind of a high point to sell.
But what Scott is saying makes sense, that even though they may take a loss on the dollar to dollar side, they actually make out because the dollar is so strong versus the yen. They actually
So
make a profit.
If I could, I think this is interesting. I'm sure that it's a piece of this, but since we have no concept whatsoever of how big it is, I think we should probably move on to something that we know something more concrete about. Well, what we do know is that refunds are extremely large. If you look at them on a quarterly basis, they're seasonally adjusted quarterly basis. The first quarter of 2023 was the largest amount of refunds we've seen in a decade. And the fourth quarter of 2022 and the third quarter, well, the co-stores include the last set of tax credits, so maybe we don't need to talk about those, but they're incredibly large. And the decline in estimated taxes is not, it's large, but it's not as large.
And this is taking into account the so-called constitutional refund. It's still
well,
looks
it's
like
in there.
it looks like about
it's in the data.
125. Yeah, it looks like it's about 125 million to me, more in refunds. Because if you have 934, 497, about a half million, you add in the 311, I'm sorry, for the constitutional refund. So that's roughly 611 versus 930. I'm sorry, 811, or maybe 805 versus 934.
Just to let you know, the preliminary statement separate pulls out the constitutional refund. So you guys can have, I'm happy to show you this. If you want to look at the graphic, you have the preliminary numbers and I can show you in the presentation, but they pull them out. So you can see the change without the constitutional refund. You guys don't have to do the math.
So it's 622 versus 497. Right?
Yeah, and that's
Yeah,
without the
yeah.
constitutional
About
refund.
120, about 125 million is what I, yes.
Mhm.
Yeah. But that's large, as Dr. Bonham is pointing out. It's a large difference. It's, about 25%.
I think a large part of what's going on here is that the year 2021, there were large capital gains that were recognized, not only with the real estate market, but the stock market. And those taxes were paid in 2022. Conversely, in 2022, there were large amounts of losses and people did not have those gains to pay taxes. So I think that is a big part of what we're seeing here. And we're not going to see this repeat again, I don't believe.
Yeah.
I
That
agree. Because
That was actually the point I was trying to make, was that it feels like we're past the adjustment for, so the refund should recover back to more normal, smaller levels. Estimated taxes will probably continue to fall at least until our local real estate market bottoms, which I think we're on the verge of, if not already having seen it. And who knows what's going to happen in the stock market.
Getting back to what Christy mentioned, if there was a large gain last year and they recognize a gain for estimated tax purposes, what the tax preparers do is they basically do they have the client pay in the prior amount usually, or 110% of the prior amount, so that it can cover for any underpayment penalties. And so you would have a abnormally high estimated tax payment in this year, and then when they file the return for 2022, they could get a refund. So they'll just be too much because of the gains that they might have recognized in 2021. So it affects 2 years. One, the year that they had the gain and they had to pay the additional tax, and then the subsequent year when they had to withhold or pay in more estimated taxes than normal.
So what you're saying is that in this fiscal year, which would have been both last calendar year and this calendar year, people were paying estimated taxes at too high of a rate because they were paying at a rate to cover their previous year's tax liability. And so then with their losses, that helps to explain the surge in refunds.
Yes, because
that makes good sense. Yeah,
that's what's happened. Is I've seen the computer automatically provides for estimated taxes based upon the prior year tax. And so that means that if you didn't have the kind of income in 2022 that you had in 2021, then there's going to be a big refund coming in and on your 2022 return.
So basically we can blame all this on tax accountants using silly software that didn't take into account an estimate of what these people were actually going to earn during the year.
Nobody does that computation usually.
So even though it could save them a lot of money paying in, it could save them from paying in a lot of money.
Yeah.
The reality is most people are paying based on an inflated base.
So it's
just to make it a little bit more clear, you're penalized if you under withhold. And there is a safe harbor, and that's what Marilyn is talking about. You don't know throughout the year what your tax is going to be. So you don't know if you're going to have gains or not until the end of the year. So the safe harbor means that you tend to over withhold in certain years and under withhold perhaps in others. So
and there's one more factor, is that the state charges a horrendous amount of interest.
It's a high interest
rate. Isn't that right, Kurt?
Well, it was. Now it's not so. Now the difference is not as high. Because
So what are we going to do for this fiscal year?
Yeah, there's only 2 months left.
Yes, and I think,
Yeah.
I don't think we have time in 2 months to make up for the little shortfall that we've had so
Yeah.
far this year.
Yeah.
So I think we have to look at that very carefully.
If we assume 0 for May and June compared to May and June of 2022, then we come up with negative 0.9%, call it negative 1%.
which is where we are right now.
We're at, I thought we were at 2.
No,
Well,
We're
latest
at
one.
2, but the
Yeah, we're two.
actual
Year-to-date.
collections is at negative
Yeah,
0.1,
right,
right? Or negative 1%.
right.
But I think, Dr. Kobe, were you kind of indicating that for May and June, we probably we're not looking at being even?
I would, I never opine on these things, but I'm
That's our job.
assuming negative growth.
Negative in the last 2 months?
Yeah, the month on month growth for the next 2
Okay.
months,
Well, how big a negative?
like 1%. Yeah, or like,
It's not month on month, it's year over year.
yeah, year over
Okay.
year. Sorry.
Mhm.
Thank you.
Um,
I wouldn't, I don't know. Not big, but
Look,
like,
the real question in my mind is what's going to happen with the refunds, because I do think estimated taxes will continue to be below last year's level and continue to fall, but the refunds have been so large, and so the question is, are May and June going to continue that trend?
What
Well,
do you-
people on
what do you see,
extensions will be
Marilyn?
filing their returns.
Yeah. What are you seeing, Marilyn, in the returns year fund?
I think that I have clients who have refunds coming. I look at the returns, we put it on extension. It was really easy because it was a refund. So what I'm seeing is that those clients are going to get a refund. Who
Next
put
fiscal
their,
year.
But
Yeah,
when are they gonna
August.
file? When are
for
they? gonna file?
2022.
I mean, I won't file until I get back
October,
to
probably closer to
Hawaii.
October.
I'll be lucky if I file by July.
Yeah,
Yeah, most people wait till October.
we're close to
Yeah.
it, yeah.
So,
Plus, some people have to wait, right, practically, because they have K1s from partnerships, LLCs, and
Right.
trusts and estates.
but there are some returns that are going to go out that I know are going to get refunds.
Mm.
And it was easier to do the calculation because they were going to get refunds. So it's easier to do a extension without
Mhm,
worrying.
mhm.
The people who did
Well,
owe taxes, we
So
had to pay in.
where do we
Yeah,
end up if so look, the easiest thing to do is to assume that the growth rate for the next 2 months will be the same as we've had so far,
Which is
year
minus
to
1.
date.
Yeah.
Yeah.
What is
Yeah,
negative
Where does
1?
that put us?
yeah.
Puts us at 1%, a negative 1%.
Okay, so basically the
Okay.
next 2 months are not doing a lot because all the action was really in the last few months
Mhm.
with the really big April deficit. So I'm comfortable with minus 1%. I think my model said 0 or 0.5.
My model said 0.
My model was the lowest, so, but I don't think the model takes into account where we are year to date. I think it's, it
Well, the
doesn't-
quarterly model tries to do that, but unless they're inputting the April data and using that as an estimate for fourth quarter fiscal year, you're right, it's not. It completely misses the April.
Yeah, and it was April that had the big turn.
Yeah, April was minus 11.
So I'll
April
move
over
minus
April.
1%.
Well,
I s-
but that's
I-
assuming that we have 2% growth for the rest of the year.
No,
No, it's assuming minus 1% for the
negative
rest of the year.
1%.
Yeah.
9 minus 1.
I second
Mine.
I second the
mine-
motion.
Okay. I'm just wondering if it's low enough. That is my.
Oh, okay.
Right.
We'll wait.
No, you don't
No.
have to agree with me, but I'm having trouble because I can't seem to get the little thing to work for me.
I think the thing that
worksheet.
intervened between our last meeting and now is all the bank failures. You know, that's what I'd be worried about. Because the small banks are being hit by, you know, and if you look at what happened with the balance sheets of the banks and the fact that they were holding all these long-term securities and the interest rates rose and people on deposits were getting so much less, they have to raise their interest rates, I guess, to consumers. And I guess I see a slowing of economic activity because of the fact that the
Ooh,
small
Marilyn,
banks.
we're talking about this fiscal year. We're talking about the
Yeah.
next 2 months. Okay.
No.
So don't,
Yeah, I agree, but
um,
I still think it's going to be affecting, you know, from March to now.
Unfortunately,
to
I
June.
can't input anything into your wonderful little spreadsheet, Seth. But just if you put in -1 for the rest of for the last 2 months, it comes out as -1.
Yeah, it should come out -1 because
Yes, it does.
you're just keeping the 10-month average, right? The
Yeah.
current 10-month
Right.
average of,
yes.
yeah.
I'm having technical difficulties enabling the worksheet to work for
Yeah.
me.
Yeah. But if the year to date is -1, right? And then we're
Yeah, no, it makes
adding
sense.
in 2 more -1s. Yeah.
Yeah,
Yeah.
that makes sense. And as I said, my model was -0.9.
Okay.
All right.
Minus-
Perfect.
Okay,
So
perfect.
any further discussion? I guess there's only been a motion. Is there a second?
I second. I
Okay.
mentioned this second.
Okay. Oh, sorry, I didn't
Yeah,
get.
Marilyn jumped all over that.
No.
Okay.
Okay.
But then you're
I'm
gonna,
okay too,
okay.
for what it's worth.
Councilmember Hayashi? Any
No, I would
comments?
agree. I think that makes sense. I do see what Christy's saying, especially in light of, I think, what Carl said about June and some of the softening there. I mean, I look at the tax collections in June of 2023 at 850 million, 851 million, or I'm sorry, 859 million last year. And then it's dropping to 851 million, which is still significantly higher than 2021. I mean, it's so high above everything else. So that would be my only concern, whether or not June is overstated right now, and whether or not we need to make some
Oh.
kind of adjustment to June more than
Okay.
1%.
So, yeah, I don't have my June.
Yeah, June 2019 was 590
Mhm.
million, and June 2020 was 478 million.
And how about 21 and 22?
21 was 735 million. 22 was 860 million. And if we assume -1%, it's 851 million.
Any further discussion of the motion before us?
So the concern is that we might be even though we're reducing it significantly, we may not be reducing it enough.
Yeah.
It's almost like we're chasing something down.
We are,
Yeah, that's what happens.
yeah. And then
Yeah.
when you have a deceleration like this, it takes us a while to catch up to that.
So we always
Or
tend
so.
to overestimate rather than underestimate, which is,
Well, that happens when there's a deceleration. If there's an acceleration, we tend to underestimate also.
Yeah, yeah.
so
That's it. Yeah, that's
deceleration.
great. Yeah, we tend to trail. That's the historical pattern of the core.
That's a historical pattern of forecasting.
In general.
Okay.
So one of the so I would argue that the situation in the banking sector is having a minimal effect on tax revenues currently in this fiscal year. There's certainly increased downside risk for next fiscal year as banks cut back on lending, and they are cutting back on lending. They were already cutting back sharply, and the data, we actually just got the data, I think, for Q1 from the Fed's survey of banks, and it was negative. It was a worsening situation, But as I said, it had already been actually much sharper declines in lending than we just saw in the last 3 months. And then we also got GDP numbers and income numbers and lots of numbers for the national economy that continue to show a pretty robust economy. So I'm not too worried there. The one thing that directly affects our tax revenue forecast is inflation in the islands, and inflation has come down really, really sharply. Basically, I'm not sure I actually know. Let's see. Not sure I actually know the number, but there was a chart in our last forecast report that showed the 6-month annualized inflation for Honolulu. It's essentially zero. So while if you look at the year-over-year number, you're still talking about 3 to 4%. If you look at the last 6 months, it's fallen much, much harder than that. And so that tells you where we're going to be going forward, right? Because what it's doing is it's taking out the low base at the start of 2022. Basically, on a whole number of categories, even food, inflation rates have fallen to near zero. And so I would argue that the CPI inflation in the council's forecast is too high for next year. And actually, not to make things more complicated, but our forecast, the council's mean forecast for construction activity is ridiculously low. It's I think it's 7% for this fiscal year, and for the data we already have, probably 3/4, I'm going to say we're probably at 13%. We're probably twice the council's forecast.
And that's a very important component of our models.
Yeah.
So is this a
that's more of
23
a
discussion or a 24 discussion?
yeah. Sorry, I'll be quiet.
Okay.
Well, I just want to close out 23.
I mean, the inflation numbers I think do bear on 23. The construction numbers bear on 23 and 24. But I don't think we're not going to change our 23 forecast because the council under forecast construction in the model, right? We're not going to raise the forecast from -1%.
With respect to the inflation numbers, what I'm seeing is the employees who are having to pay higher prices, the grocery store, wherever, are demanding higher wages. We have strikes here, strikes there, all over the place. Everybody wants
Where do we
higher
have
wages.
strikes here, strikes there? You're just talking about the hospital on Maui?
Well, hospital in Maui, the airlines, United and American, are striking, the pilots.
In Hawaii?
Well, I guess that's nationwide, yeah. So there's employees that expect to have higher wages because of all the information and newspaper articles or whatever mentioning the inflation rate and the fact that it costs so much more for eggs, it costs so much more for everything. And so the employees are saying to the employers, well, if prices are going up that much, I want to raise so I can afford to live as I lived in the
So
past.
then, Marilyn, that is an argument for a higher tax revenue forecast,
Higher inflation rate.
Yeah.
aka a higher tax revenue forecast.
Until the employers go out of business because they can't afford to pay the higher wages.
Well, then
Why can't they afford to pay the higher wages
will
if
go
they're
down.
charging more for the goods they're selling?
Yeah,
It doesn't work that way.
they charge more for the goods and they charge more for the services, and the customers won't pay, and so you end
I
up.
think we're running a little
All right.
astray
Yeah,
of
yeah.
May and June of 2023, please.
Yeah. Are we ready to vote? Any further comments about fiscal 2023? Okay, so the motion is for -1% for fiscal 2023. Vice Chair Newell,
Yes,
Dr. Siderhoff,
Yes.
Dr. Bonham,
Yes.
Councilmember Maynard,
Yes,
Councilmember Hayashi.
Yes.
Okay. The vote carries unanimously. Next item on the agenda is the next fiscal year, fiscal 2024.
And we're
Oh.
on record for 4%, right?
Yeah. But if we're bringing down the base, typically we look at, that's one of the factors we look at. We're bringing down the base 3%. But my question, I guess, to Dr. Bonham and Dr. Siderall is, are we going to have a recession like in 24, first half of 24?
Yes,
Some people think we're already in a recession.
no. It's going to happen sometime. If you wait long enough, our forecast will be right for some year. You know, I think it still feels like the widest held view is for a mild recession in late this year or early next year. Regardless of whether we actually end up getting a recession called by the NBER, things are going to slow down. And the forecast we just released still was actually a little bit of a stronger forecast than our previous one, just because like the U.S. economy, Hawaii's economy, in a macro sense, sort of continues to grow faster than we expected. The visitor numbers are stronger than we expected, mostly U.S. of course, and certainly construction surprised to the upside on job growth has been pretty insane in contracting over the last 3 months, 4 months, and so our forecast is that Hawaii won't experience a recession. That we'll get through this with just a market slowdown and a small uptick in unemployment and sort of a weakening of wage growth and weakening of job growth mostly.
Yeah, and the weakening of job growth and wage growth is somewhat mitigated by this huge pool of consumer cash that's sitting in various forms of savings accounts that consumers draw on to maintain levels of consumption that are, perhaps higher than the jobs numbers and the income growth would indicate. So I think that's one factor that plays it, that makes it difficult for us to forecast this sort of stuff.
The latest numbers that I've looked at regarding sort of excess savings is that we've burned through about half of it, if not more. And it's I also think it's mischaracterized as sort of liquid balances that are available for consumption. And I mean, it's true that's available for consumption if you lose your job, but so basically low-income households have completely burned through it, right? The bottom half of the income distribution is pretty much wiped through it. So if you're talking about the top half of the income distribution, I would argue that a whole bunch of that cash is actually intended for investment purposes, and it's sitting there waiting for a place to go, right? It's waiting to see if the stock market falls another 5%. But if those people lost their jobs, so if you were a tech worker and you lost your job and didn't get reemployed, the money's there to spend. So
what about the retirees? Demographically, we have an aging population, and they start becoming more conservative and saving more and more money. We have that problem in Hawaii that I believe that I'd like to see us address that to a greater extent.
Don't the retirees spend money?
No, they don't. I just watch my sister.
So remember, are we doing fiscal 24? Are we doing fiscal 24 now? Is that the
Yes.
Or are we doing all the out years?
Fiscal 2024.
Okay, so we're talking fiscal 2024. Then the retirees are basically the same as they were in fiscal 2023. They're just that's not that different. Now, if you're talking 2030, that's a different story.
Oh, actually, I see a lot of people retiring now. You know, they're just,
Yeah, but okay, so what are we talking about? 100,000, 1,000, 100, right? It's not going to make that much of a difference. A lot of people retired last year, and a lot of people retired the year before. Actually, probably more retired the year before.
I see business owners retiring now. Everybody's stressed out. Everybody doesn't want to work anymore. And so
Well, Jack retired 2 years ago, and my colleague retired last year. Jack retired 5 years ago.
Time flies.
Oh, we better go back and revise our forecast down. Sorry. So I'm just saying, look, for fiscal 2024, the difference between the number of people who retired in 24 and 23, it's not something that we need to be taking into account. This is a long-term change.
that long-term change is significant for Hawaii's general fund revenue collections, because everybody who goes from being actively employed to being retired doesn't pay taxes on their Social Security and their pension income. And so the state, when I do returns for these newly retired people, all of a sudden you see a big drop in their state income tax.
Yeah,
And so
but
this-
someone replaces that retired person.
No,
Hopefully.
they're all on these
No,
fictitious employees that have employees wanted, and everybody goes and says, oh, sorry, I'm
well,
short
I'm
staffed.
sorry, there's someone at UH who replaced me. Hard as it may seem to believe.
No one could ever replace you,
Yeah,
Jim.
I know,
you're
I know.
irreplaceable.
Of course.
And actually, they make more than Jack did. So
Oh,
Probably
Burn.
deserved it too.
So
Okay. that was fun.
what kind of number are we looking at for fiscal year 2024?
Yeah, I'm a
I'll move
little,
4%.
why would you, if you think the economy is going into a recession, why do you think we would have a 4% growth?
Because I think that's how fast the nominal economy is going to grow in Hawaii in 2024.
How much of that's inflation?
A couple percentage points.
Okay. 2% real, 2%
I mean,
inflation.
so in the fiscal year 2024, our real income forecast is 2.25%, and our CPI forecast is 1 3/4.
That makes 4.
And you have to account for the 300 million being added back in, yeah.
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 And also we drop in the base by 3 percentage points from 2 to -1.
Oh, but do any of the tax changes that were made by the legislature this session affect 2024 collections?
If
I
they
will
get
explain
signed
all
into
that
law.
in the September meeting.
Yeah.
They would.
The short answer is yes. If they get
Yes, it's
signed into
gonna
law, we're going to
It
have
would,
lots
it would
of fun.
affect tax collections.
Well, most of it's in the form of in the credit area, right?
Yeah, yeah, for the lower modest income taxpayers.
That's September.
So,
So what year are those credits effective? Is it
2023.
okay? So we'll probably
Fiscal
see it.
23 or?
Yeah,
No,
it's
tax year
calendar
2023.
Tax year.
so we're gonna see it in early 2024.
Right.
You'll see it in early calendar year 2024. Yeah.
Because those people, they're generally, a lot of them file their credit claims early.
But I, you know, like your job is not to incorporate that information into this forecast right now.
Yeah.
But the tax impact does affect our actual,
But you don't know what's going to be signed into law, Marilyn. Like what you're trying to do
That's right.
is you're only trying to do what is on the books right now. And so if you need to adjust it in September, then you should adjust it in September.
That's what the council has done for the last thousand of years that I've served
Yeah.
on it.
Just feels like 1,000, Carl. So,
So-
So,
given that the 4% includes the refund, I'm okay with that.
Yeah,
The impact of the refund.
because it's still a pretty big decrease, right, in what,
Yeah,
in nominal dollars, because we dropped it 3 percentage points.
so I'll
Yeah.
second Carl's
Yeah.
motion.
Okay,
if you look at income, total income tax revenues, I think, so this gets to Jack's point about whether we're going to stay at this high level.
Yeah,
When we see the first and second quarters of 2023 income tax revenues, it's going to be back down at like 2018, 2019 levels. So that adjustment is there. And in our model, we're doing this on a quarterly basis, so we're already accounting for that. All right, we've got the first quarter data in there. We're forecasting the second quarter, and so that the income tax revenues are already down, so we're growing from that lower level. And then in September, we'll change it all.
because if you also consider the so-called constitutional refund, that's about 3 points, right? That we
Yeah.
paid out the current year. So if you back that out, it's really 1%. And plus we brought
Yeah.
down the base period by 3 points.
Yeah.
So it's probably too low.
you already made the motion, Carl.
Okay, any further discussion about fiscal year 2024? The motion is for 4%, right, growth rate
Correct.
for fiscal 2024.
Mhm.
Vice Chair Newell,
Yes. I agree.
Dr. Siderham? Dr. Siderham? I don't know if you can hear
Hello,
us.
Jack.
Dr. Siderham?
You were unmuted already. Now you're muted.
Yeah,
Now he's muted.
I'm calling you for the vote. Okay.
Someone
Ah,
stole his
yes.
voice.
Dr. Bonham?
Yes.
Oh, I don't know. My motion.
I think he said yes.
He said yes?
He gave it a thumbs up anyway.
Oh, I saw
Oh,
that.
you can't hear me either?
No,
No.
we
Oh, I
couldn't
can
hear
hear
you.
We can hear you.
So we're on
Can you
you.
hear me?
Yes, we can.
Yeah.
Dr. Bonham, is it a yes or no?
So
Is there a
yes.
motion? Okay. Councilmember Maynard,
Yes,
Councilmember Hayashi.
Yes.
Okay, so the vote for fiscal 2024 for 4% general fund growth is approved unanimously. Okay, the next item on the agenda is the general fund growth rate for fiscal years 2025 to 2029. So that's 5 years. Okay,
at this point,
Yeah.
I think we're okay just leaving it at 3.5. Unless, I would make that motion unless someone has a strong opinion otherwise.
Do you think the banks will pull out of this versus having a rush on the banks, the small banks?
Yes. I mean, the examples of the banks that have failed are relatively unique and poorly managed. Of course, you don't know they're poorly managed until after they fail, because that's when you see the mess. So there are other banks out there that are equally poorly managed, but the Fed's response to that and the Treasury Department's response to that has really solved the liquidity crisis. Right, and banks have been accessing Federal Home Loan Board and the new term lending facility in a pretty dramatic way, and they're on notice, right? So they're on notice. They know they've already got the balance sheet problems and the profitability problems, and so they're acquiring liquidity in advance of deposit outflows rather than waiting to the last minute. So, will we see more bank failures? It's reasonably certain that a few more banks will fail, but I don't feel like there's a strong case for. Actually, the next shoe to drop is probably commercial real estate, and because those are on a very short-term loans, and you've got nationally, lots of commercial districts that are struggling. So I think if you want to worry about something, worry about CRE loans.
I think you're right, Carl. I think there are especially lots of downtowns where people never did really return to work. So those high-rise office buildings, as well as the businesses associated with them, like coffee shops and restaurants and other retail stores, they're really going to be struggling. And of course, with a lot of high crime in what used to be relatively safe areas and downtowns across the nation. Just more excuses for people not to go back to work in the office or to find other locations. So I think you're absolutely right, Carl. That's going to be very definitely something to keep an eye on.
Something to watch. Yeah.
Yeah.
So we're talking about the banking having problems. I mean, actually, then people would put their deposits into the bigger banks, I guess, for safety. And then a problem with commercial real estate. And the feds keep saying they're going to keep raising the interest rates. And for all the interest, they'll wait a little while and then they'll raise it again. And they admitted that, the feds admitted that they weren't really watching over the banks as well as they should have. So,
So remember, we're talking fiscal 25 and beyond right now. This is when we should be talking about retirees, not about a banking shock that happened in early 2023.
I think, Marilyn, that you're right, though, that the banks, and Carl, you touched on this, the banks are certainly tightening credit in general, and that is really the equivalent in a lot of ways of more tightening by the Fed, increased interest rates, because banks create money out of thin air, and when they stop that creation, the money supply does start dropping too. And as you've seen, maybe in some of the recent graphs, money supply actually went at negative growth. So which kind of implies that inflation will absolutely come down, but we're also, with that tightening, we're going to be seeing less credit creation in the banking system as a whole, and that will slow down the economy too.
yeah, so less business
In fiscal 24, and we're talking about fiscal 25
Right.
and beyond.
When exactly it's going to happen, Carl, you know
Yeah.
how hard that is to pinpoint. But,
Well, yeah, but so if you just want to take, so for example, Marilyn mentioned that the Fed was going to keep raising interest rates. Well, for whatever it's worth, the market would tell you that they're going to be lowering interest rates in the next 6 months.
right.
I think the market's wrong, but I will be very, very surprised if we see any kind of market increase in the Fed funds rate over the next 6 months. And so then when you get out to fiscal 25, when inflation is back down to 2.5% or whatever the number ends up being, I don't see rates falling a lot, but they will come down.
Mhm.
And you got to remember, all those people who are pulling their money out of checking accounts are now putting it into high yield savings accounts that are paying them 4 to 5%, or they're putting it into T-bills or money market accounts.
Or certificates of deposit.
Yeah.
Well, okay, so we've been talking about 3.5%, and if you assume 2.5% inflation, that's real growth of 1 to 1.5%. And that strikes me as a long-term forecast, which is basically what we're doing. Basically looking at the forecast for, on average for this 5-year period. I would say that's probably a reasonable prognostication.
Are you seconding my motion, Jack?
I'll second it,
Yes,
Okay,
since I probably proposed it at the last meeting. So we have 3.5 from fiscal 25 on.
any further discussion or comments on the motions?
by the way,
Yes,
all
maybe.
our forecasts, when you put them into the model, are above that 3.5%.
They are.
Just to, as a basis of comparison.
We're taking into account the increase in retirees.
And bank
Yeah.
failures.
Bank failures,
How
retirees,
how
commercial.
about debt cliff? You want to throw that in there too?
Well, that's fiscal 23, 24,
Oh, no, forget it.
right?
Forget it. Never mind.
Of course, if we go over the debt cliff, then we're going to be back in session to redo the forecast. And I mean, I don't know anybody who is building a forecast that assumes that we're going to go over that cliff. Now, we may toy with it and create enough disruption in financial markets, right, and drive interest rates up enough over the next month that it has significant damage to the economy. But I don't. Somebody will announce soon that they have now adjusted their forecast to assume that the U.S. defaults, but that's pretty extreme.
But not inconceivable, given the
Well,
politics.
the probability is non-zero, but is it 1% or 2% or 20%? I don't think it's 20%. I mean, I don't know what the probability is, but it's you have to assign a pretty high weight to craziness in Congress to get that result. The people that I listen to that have been talking with Congress
Crazy people.
about the repercussions of it feel like no one wants it to happen.
Yeah, I don't
Even
think,
even the extremes of either party.
Yeah.
You know, nobody wants this to happen, and they're just trying to figure out a way to make it go away. So
Okay,
cross
so-
our fingers.
so we have a motion by Councilmember Maynard, seconded, is it seconded by Dr. Bonham? Did you second it?
Sure. Mhm.
Okay, and the motion is for 3.5% growth rate from fiscal 2025 through fiscal 2029. Any more discussion or comments? Okay, we'll take a vote. Vice Chair Newell,
Yes,
Dr. Saidar,
Yes,
Dr. Bonham,
Yes.
Councilmember Maynard,
Yes,
Councilmember Hayashi.
Yes,
So the vote for a 3.5% growth rate for each of the fiscal years from fiscal 2025 to fiscal year 2029 carries unanimously. Okay. Next item on the agenda is the above and below the line discussion. Okay. Dr. Kobe, do you want to kind of start us off?
Sure, I'll do that. Hold on a second. Okay, so there is last meeting I just mentioned that you guys are doing a below the line forecast, right? So
Yeah.
that means that you guys are consciously putting in all the effects of the tax credits, all of the accounting adjustments and everything. And, you know, over the last 3 or 4 years, that's really difficult, right? It's difficult to do math in your head, and it's difficult to adjust for these proportions. So like a good example of what we're trying to, the challenge that you guys are trying to fix is like on the fly, you guys are trying to figure out, okay, what happens if if we have a lower base and we expect $330 million to come in, right? I can give you some heuristic devices like 3.3%, but it's not very It's not very exact. The other thing is, you know, for, you know, child tax credits, things that really affect legislation that affects revenue, you guys have to heuristically put that into your thing versus, you know, what most of you guys would do, since you guys are all very quantitatively oriented, you would build a spreadsheet, right? And then you would subtract that out and you would figure out what the numbers is below that. So that is essentially, there's this dilemma, right? So below the line forecasting gives you guys a lot more discretion to do things and change things. It's a lot easier to match with the preliminary number exactly, versus above the line is you don't have to deal with that, right? And you are focusing more on the broader macroeconomic variables. So I just did this, which shows you some like pros and cons to each approach. I don't think there's any one that is a slam dunk, and you guys have to decide how you want to do it. The pros of a below the line forecast, which is what you guys are currently doing, it gives them more flexibility to the core. It's easier to like just look at the preliminary number and say, oh, that's what we really want, and match that. On the other hand, it's very difficult to calculate large changes in revenues, right? So one of the things that occurred during the COVID crisis is when things were moving around so much, it's just hard for the human mind to put percentages into it. It's hard to account for accounting changes and tax law changes, right? So when you think about the below the line, you base it like you have to do everything yourselves, right? In this discussion that you have with one another, and like add in the macroeconomic variables. The advantage of the above the line forecast is if you decided to do that, you farm out a lot of those like more minutia out to TRP, right? Which is what we just add everything in, and you're really focusing on above the line forecast, which is more like thinking about the banking crisis, thinking about these retirement issues, what's real growth. The one thing that would become probably a little bit more important is the models, right? Because it's bigger, it's more about these macroeconomic variables. And just as a reminder, the models are only as good as your inputs, right? So the models really depend on your input. So you probably would have to focus more on the inputs of different things. And another really big thing to think about is if you did want to go to above the line forecasting, it would take some time to move away from the below the line forecasting to above the line forecasting, right? Because basically right now, you guys give us a forecast and we like jam it into our models and we backward figure out the above the line forecast. So the above the line forecast is pretty hard to understand, and none of us really look at it very much right now. If you were to do that, we would have some kind of transitionary period, which would add some uncertainty. I just put this out there so you guys can have a discussion about it was requested by you guys to have this discussion, so I'm laying it all out there. If you have any discussions about how like the models would work or how different things would work, I'm happy to answer that for you. But again, this is you guys are the council members, so it's ultimately up to you to decide which is the best approach to take.
Could I say, I prefer to the below the line forecasting, and I would like to look at the tax numbers too. In the past, we had estimates made by the tax department for the effect of things like subcontractor GET exemption. And, you know, when they changed that, we went and significantly changed the amounts that were calculated by the tax department. And to me, those numbers calculated for the legislator were like unknown, because there was no computer there's no calculation of the actual figures for that tax increase. I mean, there was none. And so it was kind of like a guesstimate, and we disagreed with the tax department on the estimate. So, you know, when they go to the legislator and says, this costs this much, this costs this much, the data was not there. And so we'd like to look at that. And also for long-term demographic changes, like how the demographics and the pension and the Social Security exemptions would affect the general fund revenue collections. I think that is pretty important when we're looking at the general fund forecasts. So those are kind of things that I'm not sure that the tax department would be focused on, because they'll be focusing on year by year type tax changes. And I'm kind of looking more at things that affect the whole general fund collections, taking into consideration external variables. Not just a year by year, okay, we'll get this much money from whatever, because there's changes that are going to be occurring to the model. This is a forecast, not a historical or whatever. So we have to look ahead and estimate what we think the effect would be for what's happening with the economy and the population and the tax treatment of that. I mean, I haven't seen any numbers come up. When I was on a tax review commission, I had the study drawn up about, okay, do we have is the tax system as currently constructed for the state, is that going to be adequate when 20 years from now, for example? And the answer was, oh yeah, it's going to be that, because we have 7 to 8% interest, and we're going to collect all this revenue from the retirees on their savings account. And so that's what's going to keep the economy going. But I look at that and I see, okay, the amount of savings that everybody has actually is quite a bit lower than what was forecast in the back, way in the past. And so now we're here with a tax system that may not be adequate to fill the needs of what Hawaii legislators might think their needs are.
Anyone else? Dr. Sadahan?
I'd like to ask Seth, how would our processes have changed for forecasting fiscal 2023 had we gone to this format of above the line forecasting? I mean, what would be our starting point, and what would we be forecasting? And then, after we forecast fiscal 23, what would our fiscal 24 forecast be based on?
Yeah, that's a great question, Jack. I think the process, again, there would be some kind of transition period, right? Because right now, you guys would have to like essentially start out from zero all over again, right? For the top of the line forecast. So if you were to
start at some beginning year,
exactly. So in that case, the process, yeah, the process of figuring out fiscal 2023 would be exactly the same for the month of May, right? If we went back to the month of September, what you would do is you would be like, okay, how much do we think it was going to increase over 2022? And then we would have adjusted for the constitutional refund.
Right.
That's the only difference.
Okay, so then we end up, and so we meet again September and December and May, March and May, right?
Mm-hmm.
And what are we doing? What are we doing with that fiscal 23 forecasting? We're still doing above the line. Are we making adjustments to? I mean, from that fiscal 22 starting point, are we saying, okay, we're going to take that starting point and we're going to create a forecast for fiscal 23 in September, and then we're going to modify that forecast in the next 2 meetings? And all the time that we're doing that, you guys have these below the line numbers hanging out there.
Right.
We make the forecast for fiscal 23 raw, above the line. And what do we report to the governor?
We would purport the below the line forecast, because what the governor is interested is the below the line forecast, right?
Right. Okay, so the council, so you write a letter that says the council says that this above the line, the Department of Taxation has subtracted 300 some million dollars for the refunds, constitutional refunds, and therefore our forecast for fiscal 23 is X.
Right.
That's what the letter would say.
Yeah. I mean, you could write the letter however you want.
Well, of course, yeah,
Right, yeah.
but something that would be the contents of the letter.
What are we
So-
charged with by law? Are we charged with being responsible for the bottom line?
So
Yes. Yes, it's a general
Okay.
fund revenue, which includes the tax considerations of how much tax collections you'll be beginning
of
from.
course,
Yeah, so we are
Okay.
forecasting the below the line. And my point is that I don't want to just deal with economics thing. It should also have other factors
Carl.
involved. Yeah.
Dr. Bonham, did you have a comment or question? Dr. Bonham? Carl?
so I'm the only person who's probably talk.
We can't hear
nice.
you. You're coming in and out.
Am I muted?
No,
Oh,
there's
yeah.
latency in your
Yeah.
feed.
And
Can
we're
you
not.
hear me now?
Yeah,
Yeah.
we could hear that.
Can you hear me now?
Yes, yes.
No.
We can't hear you now.
We can't hear you, Carl.
So I'm probably about to drop off anyway because I think my battery is almost dead. I think I'm the only one who's. All right, never mind.
Hmm.
We can't hear you, Carl. Any other comments? Or will we wait to Carl to rejoin us?
I would just say that, yeah, I would agree with Seth that sometimes the math is difficult, and especially if we're used to using percentages when we have huge swings like we've had in the last few years with the pandemic and then the refund and all of that. The math can be a little bit hard on the fly. I tend to agree with Marilyn. I liked having the control over the whole thing, and I can do the math. I set up my own spreadsheets and try to figure out the math on my own, and look at the percentages and change that into dollars, and try to take all of that into consideration. I would also agree with Seth that it is a lot more work, but I'm okay leaving it the way it is.
Yeah, another option is to just, while you're talking, I can build a spreadsheet up ahead of time with the account, all the revenue shifts put into the everything. And you guys are calculating the top of the line, and then you immediately see what the bottom of the line things work out to be. That's another option. And that will give you control over both, or that will give you insight into both numbers.
I found your little spreadsheet now that I finally can actually input things into it. I mean, I found your spreadsheet is very helpful. For example, when we're trying to figure out what is the impact of the last 2 months of the year when we on the whole thing. So that was a very helpful addition to our arsenal. So thank you, Seth, for that.
Can you hear me now?
Yes,
Yes.
we can.
So I've been through this process before.
Uh-huh.
And frankly, I don't think the council has ever stuck to a above the line process. And the reason is that it's extremely hard to do that as you progress through the fiscal year and you've got the incoming preliminary data, right? So then so let's say we did our, we spent as much time as I do on the macro assumptions. We all submit our perfect macro assumptions and we plug them into the tax models and we get our above the line forecast. And then you've got the below the line adjustments that are based on calculations of the impacts of whatever the trees are, right? We're trying to do the forest up above the line and all the trees are down below the line. And then we get a number and from that, and it's 50% different than the incoming tax data, right? And so what ends up happening is then the council ends up debating those adjustments, which it serves a purpose, right? We are, so for example, during the high-tech tax credits, we spent ridiculous amounts of time trying to guesstimate how much was going to come in the form of tax credit claims. And, so we were doing an above the line process, but then we always ended up talking about the below the line adjustments. I think there's sort of a middle ground that is useful. If we could try, I have a problem with the above the line because you really need to back out the tax law changes that are already in the tax data and are continuing for the rest of the year to do that. And it's challenging. I don't know how helpful that was, but
So Carl, what's the bottom
Thank you,
line
Seth.
of what you were saying? We lost Carl. Yes, we lost Carl.
I don't think that the council has, even though we pretended to do an above the line process, even though we have pretended to do above the line process in the past, we always end up coming back to at least, we have to decide on the bottom line number, right? That's what gets submitted.
So what you're saying, Carl, is like in theory, the above the line sounds great and everything, but when the rubber hits the road, like it's just impossible to resist doing a below the line number.
Yeah.
Well, one way or another,
That's right.
One way or another, we have to.
I think if we could move a little bit more towards. All right, I've had enough of this.
Okay.
I guess my question is the formulas that we're using right now, in the last few years, we found out how much the Fed funds impacted the growth, general fund growth rate. And I was wondering whether the formula that we do have, which does not consider how much federal funds are coming into Hawaii, whether that can be added in somehow. If somebody can grab that data and add it into the model that we have.
Well, I don't agree with your characterization, because the money that flows in from the feds ends up in people's pockets and gets spent. And so it does show up in what we assume about visitors. It shows up in what we assume about personal income and GDP. So it's, it's not that we ignore those numbers. Those numbers show up in our assumptions. Maybe not explicitly, but implicitly they do.
Yeah, I mean, you're responsible for providing TPI, and that's where the it would show up in TPI or construction or all these things. And that's what it really relies on, the member forecasts.
Seth, I don't get this feeling that there's a strong desire to move away from the bottom of the line forecast with all warts and all.
Great. Well, we're here just to like support you as best as you can in helping you make decisions. So I just wanted to put that out there
No,
for
thank you.
discussion. And if there's
Dr.
anything
Kobe.
else that we can do, a middle road you want to discuss, we're here to serve you guys. So just let us know.
Yeah, we appreciate that, Dr. Kobe. Next item on the agenda, unless anyone wants to discuss it further, is Department of Budget and Finance and other revenues. Mr. Chun.
Good afternoon, Chair and Council members. My name is Donovan Chun, and I'm with the Department of Budget and Finance. We have provided you with our report of revised projections of general fund non-tax revenues, non-general fund tax and non-tax revenues since the March 7th meeting. The revenue estimates were prepared by departments in March and were based on point-in-time assumptions made by the program and the department staff. Our report includes a summary of significant changes, and I will just highlight one. Let me share this.
What page are you going to, Donovan?
You should be able to see it. Page
okay,
table 2A.
Right.
Okay, so for the use of money and property, this is for multi-year revenues from sources other than taxes. Yeah, general fund non-tax revenues. There's a spike right here in FY23, and that reflects increases in the interest rate as well as the deposits in the general fund. Other than that, we've explained the rest of the significant changes. So that's the only one I really wanted to point out. So although this one is high and the out years are more consistent with what's been happening, that's just because we had accumulation of general funds and the interest rate increases. And that's the only item I wanted to point out.
So it was 45 million difference.
Yes, yes.
That's it. Earning higher interest on our.
Yeah.
And on a higher balance, yeah.
So the balances are higher also.
Yeah, so in the out years, we do not anticipate as high carrying balance, especially after this session.
Any questions of Mr. Chun? Okay, thank you, Mr. Chun. Vote by, is there a motion?
I move to accept the report.
Second. Okay. The motion to approve the report by Budget and Finance, Vice Chair Niwal.
Yes, accepted.
Dr. Saidal,
Yes.
Dr. Bonham.
I think we lost
Okay.
Dr. Bonham.
So I think we have to, Dr. Kobe, can we note it in the notes that we lost Dr. Bonham? Okay, we still can go forward though, right?
Correct.
On this, yeah. Okay. Council Member Maynard,
Yes,
Councilmember Hayashi.
Yes.
Okay, so the vote to approve BNF's report is approved unanimously 5-0 with noting the I guess the absence of Dr. Bonham.
Thank you.
Okay. Next item on the agenda is,
Thanks, Donovan.
yeah, thank you, Donovan.
Thanks, Donovan.
Okay. It's the next meeting. Dr. Kobe, can you tell us where the appointments are? I think everyone is up for reappointment, right?
I believe so.
Has anyone been reappointed yet?
I have not gotten any notification.
Okay. Has any council member been notified yet?
No.
just verbally.
Okay. Okay,
Are you gubernatorial or?
The governor
Yeah.
has not shown anybody as being appointed to the council.
okay.
And that didn't, it was supposed to have been approved by the Senate before they left, but there was no name put up.
Can people hold over for the next meeting? How does that work?
I would assume so. I don't know. I really don't understand how this, usually you guys are appointed by now, so I can go back and look at
Yeah.
these issues. My suggestion is that you guys go ahead and schedule the meeting as if
Okay,
you guys were here, and if there's been any other changes, then we can accommodate those.
Okay.
Councilmember Hayashi, has the speaker told you he's gonna reappoint you?
I got contacted. Yes.
Okay, so it looks like some of us, it's in the process.
Well, mine is through the Senate. so,
Me too, yeah.
yeah.
I think that-
gubernatorial, so-
Yeah, gubernatorial is, my understanding, it's 4-year terms rather than
Right.
2, and they also have to be confirmed by the Senate, is my understanding. Okay, when is the next deadline for the personal income forecast? Is it August 1st?
5th.
August
5th.
5th.
August 5. August 5 is a Saturday.
Mm.
August 1 is a Tuesday. 31st of July is Monday of that week.
Is there a preference for Monday or Tuesday?
I prefer Tuesday, but it doesn't matter.
Okay.
Yeah, I prefer
Tuesday works better
Tuesday.
for me too.
Okay, yeah, Tuesday's probably better.
August,
Oh.
when? This,
August
1.
1st at 2 o'clock is what we're looking at right now.
Does that give people enough time?
Does that give you enough time, Dr. Kobe?
Yes.
Okay. So Councilmember Hayashi, is that good for you?
That works for me. Thank
Okay.
you.
Okay, so the next meeting for the Council of Revenues on Personal Income will be Tuesday, August 1st at 2 p.m.
Sounds good.
Okay, if there's nothing else, thank you, everyone, and we're adjourned for the day.
Thank you.
Okay.
Great.
Okay,
Thank you.
Thank you.
Thank you.
Thank you.
Okay.
And Kurt, I'll get you that letter today.
Okay, when is the deadline for this letter?
It's late. It's like the 31st. But
okay, so-
I'm leaving for extended period of time on Friday.
Okay,
Thursday's
yeah.
my last day, so I'll get it all out to you, and we'll get everything
Okay.
done by Wednesday, hopefully.
Okay,
how long is the extended period of time?
3 weeks.
Okay, that's
Okay.
not too long.
okay. Okay.
Enjoy the
Sounds
break.
good.
Thanks.
Okay, thank you,
Thanks.
everyone.
Bye-bye.
Okay,
Okay,
bye.
thank you.